wanted to ask you about what we started the show with, and that is Twitter and Facebook, and particularly the reaction or non-reaction that we have seen in their share prices. Now, regulatory risks, that's nothing new, but it feels like it's getting more specific, especially now that the FCC may be looking to focus on Article 230. Do you think that investors are being complacent, or this is more noise like we've seen in the past with very little chance for real action?
Yeah, I mean, I think the good news is we've had historical precedent for this in that we had Microsoft go through a 10-year battle around this. And then as you rightly pointed out, Deirdre, we've had these things around Cambridge Analytica. Oh, no, it's going to be terrible. And extremist videos being posted on Google sites, and that's going to be awful. And we've had a lot of other things that have happened, and the stocks basically have seen right through it. Their businesses have been fine, and they've continued to grow. So I think, from my perspective, I own Facebook, I own Amazon. Yes, is there going to be something that happens just because populist sentiment is? Yes, we have to attack big companies because they've been successful, even though in other parts of the world, like China and Europe, they're trying to build their companies up. So I think this is really stupid on our part. But having said that, I think investors are rightly sort of saying it's not going to be a big deal. And it'll probably be 4 or 5 years, if you look at historical precedent, for anything to happen anyway.
Right. A lot of folks agree with you there. Now, I want to look at the bucket of stocks that you do like at this current moment. Recovery bucket is one, includes names in automotive and green energy. I thought what was interesting, though, is that this doesn't include malls, airlines, cruise lines, hotels. Is that because you see structural changes amid the pandemic that you think are going to outlast the current pandemic?
Yeah, I mean, I call them the Mach 4, malls, airlines, cruises, and hotels. And if you look at that space, that's where we have our shorts focused, and the financials in particular servicing that. Because, before this all happened, obviously e-commerce was growing pretty rapidly. This pulled in 2 to 3 years worth of demand into this year. And you've seen the demise of malls in particular, getting worse. And I think you're going to see 30–40% of mall space getting rationalized as we go through this. Same thing with business travel. We're obviously doing this interview through Zoom. A lot of business meetings now are being done through Zoom, and that's going to kind of continue even after the pandemic's over, because people are figuring out getting on an airplane for a 6-hour flight for a 1-hour meeting, that might not be the best use of your time. So I think there are some structural changes that were already happening that the pandemic has accelerated, and that'll be sort of permanent after we get through this. And people will obviously get on planes and travel and go to malls, but it's not going to be as big as it was before.
Hey, Dan, it's John Ford. I see that you have automotive and GM down here as a potential beneficiary of stimulus post-election, but I've got some concerns, namely the cold weather is starting to set in. We're seeing COVID resurgences, and there are a lot of small businesses, particularly restaurants, but also probably the businesses around them, that are going to be negatively impacted when people can't just walk around outside and do the commercial things that they can do in better weather. Should that be a bigger factor?
Yeah, no, absolutely. I mean, if you look at our Twitter feed, at Daniel T. Niles, we've talked about this, and that there's 3 big events between now and year end. And as you rightly pointed out, you've got 2 things that are working against each other. One is you've got COVID, which I've been saying for a while. It's going to ramp up when the colder weather hits. I've got 2 college-age students that are actually here and doing things remotely instead of going back to school. And, just like the flu season ramps up with cold weather, so will COVID. The flip side of that is we've seen the market this entire year really driven by stimulus. You've already had 30% of GDP used between the Fed expanding their balance sheet by about $3 trillion and government response. We're looking at a $2 trillion, give or take, stimulus bill. To put that in perspective, GDP for the U.S. is about $21 trillion. So it's about 10% more of GDP we're thinking of throwing into the markets. So those are the 2 things that you have sort of working with each other. And then obviously what happens with the election, right? If you get a $2 trillion climate plan, that'll really help those stocks. So as we said sort of in prior tweets, we're trying to stay nimble because I think there's so many things that can move the market drastically in either direction. But we're more biased for it going up just because you're probably going to get $2 trillion in stimulus regardless of who wins. And that, rightly or wrongly, and I think wrongly to some extent, is driving the market right now.
Shepard Smith here. Thanks for watching CNBC on YouTube.